Hey, good morning, good evening, good afternoon, good night, wherever you're listening from. Thank you for joining us. This is Jake Claver on the Future of Fortunes podcast, joined again by my partner in crime, Byron Wolf. How are you, Byron?
Good, brother. How are you doing?
I am blessed and highly favored.
There it is. That is a good place to be. So we are on the couple of days after the FTX meltdown. Binance is not going to be purchasing. I don't think there's any other weird lifelines available. Hopefully I am 100% wrong. In a couple of days from now, everybody that lost money in FTX gets some piece of that back. But as it stands right now, as of today, when we're recording this, FTX just seems like a big old giant turd that everybody is now dealing with. So, Jake, let's get into the FTX meltdown. Let's talk about the structure. Let's talk about what happened. And then I want to keep moving down, 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 and let's get granular on what we can do as individuals, not necessarily as these big wigs, not the owner of FTX, not the owner of Binance, but us as individuals that have a business, have some crypto holdings, have some whatever it is. Let's talk about structure. So I think this is what a lot of people need to hear. So let's get into FTX and then let's get down to where we need to be so that we can start setting ourselves up for success and setting up the entity, the structure for that generational wealth.
Yeah, I love it, man. So anybody that does have losses from FTX that's listening to this, those are write-offs at the end of the year. So we're still coming to the end of 2022 here. You're going to be putting your taxes together for 2023. So your CFO, how would you be handling this for your clients if they had some exposure and they saw those losses and there's no lifeline after this?
Yeah, so I've got a few clients that got hit with the FTX debacle. I was actually on the phone with one of them when Binance decided they were not going to purchase. I'm not going to disclose that number, but it was absolutely brutal. So we talked about some options, some things that they could possibly do. Jake and I had a conversation before this. Talked about there was a few people that able to get some of their money out of FTX by a couple of things, and I'll let Jake get into that. But a lot of people are now like, okay, this is what happened. What next? So these are going to be direct write-offs depending on how you're structured. If you are structured as an entity that was in the business of trading crypto, you were in that space, trading the NFTs, trading the crypto, that's going to be active, right? So if you already had an entity, that had that, those are your active gains, active losses. So that's going to be the best place to be there. Some people had these things, in a self-directed IRA, although there are very few that allow you to actually trade in that self-directed IRA. But if somebody convinced you that FTX was one of those, it is not, by the way. If FTX was one of those and you think that you had it in a self-directed IRA, I'm not giving you tax advice. I'm not telling you one way or the other. Obviously, I'm not your CPA. I'm not your CFO. But like for our listeners that maybe perhaps thought that they had it in a self-directed IRA, obviously, you can't benefit, but now those write-offs do occur for whatever you have in there. So that's going to go against your gains. Honestly, you're better off to get it out of that anyways, because that's just a straight loss. So you're not going to have any growth in there. The self-directed IRA, the only benefit is the tax-free growth, tax-free withdrawals later on. So talk to your CPA, talk to your accountant. If you're in that space, you thought you had anything in FTX that was in a self-directed IRA, it's not. So let's get it out of there, and let's write that off against something. If you need to amend those tax returns, do it. That would be a benefit to you.
What if an individual just had it in their name?
They've just had it in their name. Again, this is just a crypto trading, so this is going to be your passive. So you are limited to what you can write off, but any of those gains that you've had, like maybe in other cryptos, maybe in other NFTs, whatever, you're going to have that direct write off against those. And then you're going to have a carryover period. You're limited on the amount over that you're able to write off in this year, but you can move that into future
50,000, is that the cutoff for that?
Yes, yeah. So you do have some limits, but hopefully you are not one of those people that was sitting on hundreds of thousands, if not millions of dollars that got taken. in the FTX. If you are, I mean, I buy you a bourbon, man. I'll listen to you cry those tears. But I'd love to have you on the podcast to kind of hear how you dealt with it. I feel horrible for you. Like that's just a bad space to be. But yeah, I mean, if there are any big losers in the FTX and you're interested in talking about those and maybe coming up with some solutions on what you can do with those losses, reach out to us like ASAP. Let's get you on the show. Let's talk about it. I'm more than happy to get into that with you and hopefully find some solutions for you. I feel horrible for the people that really lost significant investments in that FTX. But for your individuals, yes, passive. So we're not going to have as many options, and we'll get into structure kind of on the second half of this. But if you were in that boat, this is a great big reminder to set yourself up and structure properly. So if you were just doing this on an individual basis, not as many options. If you're smart and you had good advice or whatever, and you had it in an entity in the business of trading, you have many more options. Again, if you're on that personal side and you didn't set it up, great time to do it now. So reach out to your CPA, reach out to your attorney, make it happen.
Yeah. And so a lot of these accounts that were holders on FTX, they're going to be disclosed in a public forum, the names and the amounts that they lost. So that's another reason that you would want to have an entity set up on these exchanges, so that if something like this were to occur, it's not your name that's out there publicly for people. It's just going to be your entity. And if you set it up correctly, then they're going to have a difficult time figuring out who even manages it. So I'll get into some of the stuff I heard about FTX on the back end. So I tried to put out some information as soon as CZ mentioned things on my social media 24 hours before everything really went down. I said, hey, look, these things happen quick. When it was Luna, when it was Voyager, when it was Celsius, you had about 24 hours to get your stuff off of the exchange before things did happen. And you're in a catch-22. They're going to collapse because there's going to be a run on the entity. Even if anybody believes that they're insolvent, especially in this space, everybody pulls their collateral off. And so that's what happened. Even if they had been solvent, it would have caused them to be insolvent because of all of the liquidity that would have left their platform. So they filed bankruptcy, or they stopped withdrawals is what they did to begin with. And they only did that with the international entity of FTX. They didn't do that with the US entity for FTX. So again, if you had stuff on FTX US, I don't know why you wouldn't have removed it, but people didn't. And so they reopened withdrawals after Binance had announced that they had an LOI. So we were talking about this before. An LOI is just a letter of intent. He announced specifically that it was non-binding. When somebody goes to acquire a business, they put in an LOI. And they're basically stating, if everything looks fantastic and I see that this is a good opportunity, then I might offer you a counter, like make an offer for the business. It's in no way binding. It's in no way like a guarantee that somebody's going to buy something. And so when I saw that, I was still very skeptical. I figured that there would be large outstanding liabilities that they probably wouldn't be able to cover. And then I saw that FTX legal team all left. That was the tell for me. And so some of the backdoor ways that I've seen that some of the people were able to get some of their money off of there, one gentleman was trading his crypto that he had on the exchange into NFTs and then listing them on another platform. That was kind of a backdoor that I saw people using while everything was really locked down. And then once the bankruptcies were announced, Chapter 11, they halted all trading and shut down the sites. Well, I say they shut down the sites. They were hacked, quote unquote hacked. And everything that was left there was liquidated to wherever else. And I will mention this about the XRP. They tried to liquidate the XRP to, I don't know if it was Bitstamp or Bitso, but because you can flag destination tags on the XRPL, those funds did not settle and they were not able to remove them. So that still is a part. If you had your XRP on that platform, then that's still there, and hopefully after all the dust settles you will be able to get that back. For other assets, I'm not sure. So yeah, going to be a lot of regulation that I think is brought in after this. Kevin O'Leary came out on CNN yesterday and said that he's flying to Washington and demanding regulation in this space because he had very large exposure to FTX. He was one of their promoters. He owned equity in the business and had assets on the platform as well. And so I don't know, he hasn't disclosed how much he lost, but I'm sure it was probably pretty significant being a billionaire. And he did have, I think he's stated that he's got 20% of his net worth allocated to digital assets, either through equities in the area or in cryptos specifically.
Yeah.
So I'm not sure what his total exposure was, but I'm sure it was millions that he ended up losing.
Yeah, and I think it's interesting to see that. So, granted, 20%. I mean, that's a big hit. Let's assume that every bit of that was in FTX. That's a massive hit for somebody to take. But the silver lining of that is he was smart enough to have multiple things he was invested in, and I think as information becomes more real time, reactions are significantly faster for us, and for everybody that's coming up in this age. If you're not diversified, like, you're definitely not doing it correctly, right? And so to see that, yeah, it's brutal. Like, I hate that he lost 20% or probably significantly less than that. I doubt he had all of it in FTX, but like, still a big hit. But it wasn't everything, right? It wasn't, it didn't take 100% of them or anything like that. Now, granted, our the lead in FTX, he took a pretty major hit, but that was his baby, that was his business. And I'm anybody that knows me or listens to me, I preach diversification, but I also preach, like, best investment you'll ever make is an investment in yourself, right? Investment in your business. So, with that being said, I get that those are kind of conflicting, but they're also kind of the same, right? Invest in yourself, invest in your business, but you can diversify your business, as well as diversify your own holdings. And so if everything is in one basket and it's controlled by somebody else, like, you're at the risk of that, right? And so if all your holdings are in FTX, you're at the risk of whoever's running FTX, because you ain't, and so I think that's a good thing to talk about, and setting yourself up for that and having the different entities. Jake, you had posted, I think it was on your Twitter, kind of the structure of FTX and all the different, ways that it was connected and the people that were involved in it and the different companies, different entities. What was the number you said? It was like 100 and something.
Yeah, it had like 134, 143 different entities. So the structure looked great, right? Like, there's multiple people involved. It looked diversified. It didn't look correlated, but the problem was that the debts on the assets of one company were the debts of another, and they were all interconnected, just levered up on one another. It's not like they were earning income from retail investors, obviously, but if that income goes away, or those people figure out something's wrong and they start pulling their funds off the platform, then your whole show's over, right? So when I work with a business owner to set their business up for success before they sell, I work to get their business profits coming from no more than 15% from one customer.
Yes.
And that way, that's going to look good to somebody that wants to acquire it, because if they come in and they lose one or even two of those customers, it might be 15 or 30% of the business. It's not going to be a total loss like this was.
Yeah. And the flip side, I agree with that 100%. We recently, CFO AF recently just took on a client that we are going to be working with beginning of the year. We're setting that up right now here in November and December. We'll start, January 1 with them, and they have a client that makes up about 47%. So, I mean, just massive. So I think in the temporary, those are great things to have, right?
Right. As you're building, but over time, again, you just want to diversify. And so when I talk about wealth building, all billionaires made their wealth in one vehicle most of the time. It wasn't diversified on the way up. But as they become very wealthy, then they branch out. I view it more as a tree. Like, you have the trunk of the tree as your your business that you built or your investment vehicle that really brought you a lot of money. And then at the top, you have all these branches where you've diversified across an array of things.
Yeah, and you still have your, your core of how you built, because obviously that's how you built it. So that's probably the thing the best. So staying true to the core is great, but again, like you said, diversifying out, like, use that to build and to create that diversification that allows you to stay strong, even if the core gets shaken or goes through a cycle, whatever. The reason I'm talking about the client, I'm not disclosing who they are, but the client we took on about, like I said, about 47%. But the beauty of that is that gives them true stature in that realm, right? So now they can go to anybody that's essentially of that size, maybe not necessarily competitors. That's probably not the best place to be. Sometimes it can be, depending on the company, but somebody that's essentially that size, sometimes better, sometimes not. But you can say, hey, this is what we're doing, this is what we're handling. And so you're going to broaden that scope. So the 47, maybe that brings on the other person that would have been 47%, but now you've split it, right? So now you've got 23, much better place. And we can kind of scale that continuously to get to that 15. I love what you said there. 15%, great rule. I do want to kind of circle back to what we were talking about with FTX. Like, so what happened when this started to crumble is we see the opposite of leverage. And so we've talked about leverage before. I'm sure everybody's heard that buzzword of leverage like a million times if you listen to any business podcast. So what happened is FTX was leveraging a lot of this stuff to have that growth, and even stable coins. And we've talked about stable coins on an earlier episode, but even these stable coins generally are leveraged. Like, so, and I don't know the exact stats, but Tether is probably one of the biggest ones right now, right? But even Tether is leveraged, right? And so, people are looking at it, and I think, and I haven't been to their website in a while, but their big claim that they used to have on there is that every dollar was backed by non-US securities. And that's an amazing thing, right? Anything that's backed is great, right? If you don't know, the US dollar is not backed by gold like it's been in the history books. If your history book says so, it's probably a pre-70 history book. Hasn't been in a while. So even these stable coins, they're leveraged, right? And so that can be great, and it can help you to have tremendous growth. And I do preach leverage for companies that are looking to grow. Use what you have to leverage in, make more money. But the downside of that is when it is leveraged, and people start to pull out, and the veil is lifted, and you start to see it, and people get nervous, pull their funds, transfer out, whatever. It does the opposite on the way back down as well. So it can crash very quick. And so I've had people say, well, like, how did it feels like FTX just crashed overnight. And it kind of did. But the reality is because it was so leveraged, and I don't say that to say that they were doing anything wrong, but that's just the reality of the space. Like, we're going to have leveraged holdings.
When banks do this, right? So you have a 10-to-1 is the ratio that traditionally they held for the collateral to the outstanding loans for a bank. So if everybody runs to the bank at one time, it's called fractional reserve banking if you want to Google it. So if everybody were to run to the bank at one time and pull their funds out of there, they're insolvent also. And that's about what FTX was. So they had 9 billion in outstanding liabilities and about 1 billion worth of actual collateral on the platform.
Yeah.
So by banking regulations, even though this space isn't regulated, they probably weren't far off. Just there's no insurance for people. And so when people get scared, and the rumors start to run, especially with, like you said earlier, how fast information travels at this point, it's just a very high exposure. And so I think moving forward with the regulations that do come from this will probably make sure that people do have the collateral on hand in order to facilitate withdrawals if a run were to occur.
Yeah, I mean, just the simple math of a 10-to-1 means that if you have a 10% drop or a 10% pull, you essentially become insolvent. Like, and that's a tiny. I mean, we have states in the U.S. that have sales tax that exceed 10%.
For sure.
Tennessee, where, we split our time, Tennessee, Arizona. Tennessee, 9.5%. It's almost 10%. So literally the sales tax on a purchase can be the 10% that could cause something to essentially collapse or become insolvent. So like, and a lot of, oh man, they had to have been doing something illegal. I'm not saying that FTX did or did not. I don't think that they did. Honestly, I really don't. I don't see that. I don't think that that's going to come up. But
they did have the FTT token, and there was a feedback loop that they were using with Alameda, their fund. So they would create that stable coin against their token, loan it to Alameda. Alameda would buy stable coins on their platform with it, and that would increase their collateral, and then they'd be able to issue more FTT and run the circle again. And so
banks do that all the time.
Oh yeah, I don't think it was illegal.
Yeah,
because there is no regulation in the space that says they can't. Also, right?
Exactly. Yes.
You get a positive feedback loop on that leverage on the way up, and you get a negative feedback loop on the way down, just like you stated before. So, same way if you leverage trade, if you have a position, you take a long position and you have leverage on it, you can make a lot of money if you're right. But if you're wrong, you better have collateral to cover. And that's also why you see big drawdowns in the crypto market. A lot of people take leverage longs on Bitcoin, and the bots will trade. And if they're wrong, then they pull collateral from other positions that they have. And that's why you see a significant drop across the entire market when Bitcoin drops. So,
yeah, I mean, GameStop and all that craziness that occurred about a year ago. I mean, that was leverage. It really was. It was a lot of intense. Yeah, it was a squeeze. And so we're going to see that. I mean, I'm not calling it a Ponzi scheme, totally different, 100%. But Ponzi schemes have been around forever, right? And they keep recycling. There's always going to be, there are new scams, but most of the scams are just the same thing over and over again. And I'm not saying FTX was a scam. That's not what I'm saying. But like, people are going to continue to do the same things over and over again because they make money, right? And I'm not going to say the smart people, because I definitely don't think it's smart necessarily do a lot of these things, but the people that are willing to take those risks and willing to do those things at the expense of other people, I mean, that's always going to occur. So I think, for all our listeners, it's super important. Pay attention to what's going on around you. Do your research. Jake has said it a million times. Look into what you're doing. We talked about looking at the white papers. Like, look into what you're investing in. Don't listen to your uncle or your postman about what to invest in. Do your own
research. Kevin O'Leary at this point, right? Like, you shouldn't just take somebody else's word. You should really do your own due diligence and dig into things. And if it looks fishy to you, don't invest in it, regardless of what somebody else has to say about it.
I agree. And Kevin O'Leary is a smart individual. He wouldn't be where he's at, if he wasn't. And I'm definitely not criticizing him for getting drawn into this, and I completely understand his reaction. He's a very intelligent person. I mean, this was just one of those things that happened, and I'm not saying that Kevin O'Leary got scammed or anything of that nature.
Sometimes investments go bad, right? Like everything looks right to you and everything seems to check out, and then somewhere in there's information that you weren't aware of. Right? Same thing with this.
Yeah, and he said it himself. He says, I don't, every decision I make isn't good. I invest in multiple things. I was talking to somebody, a high net worth individual that I, think a lot of, and he said, like, 10 things I invest in, I expect 6 of those to fail. And that's, to me, that seems crazy, right? Because there's only limited money, and I don't like to lose at anything. But
you have 100x on one of those and the other ones do okay,
you're way ahead.
Right. As long as you win more than you lose, then you're going to be okay at the end of the day. But I guarantee you, he used his entities to invest on that platform, and that's what's disclosed there in that public document. So let's get into that. How do we structure these things for our listeners if they want to get into that side of things to protect themselves?
Yeah, so me, I'm a huge fan of the trust. I think it's extremely, extremely rare to see true generational wealth that doesn't exist within a trust. So my advice is start with a trust. So build that trust. With that trust, you want to link in that living will, and then you want that power of attorney that's kind of over that. So you've got your trust that's kind of the top of the pyramid, so to speak. You've got that will that's tied into it, living will, pour-in will, whatever you want to call it. That needs to be a piece of that too, so that you're not having to constantly update that will. So I love a pour-in will, living will. There's a few names of it, but they all mean the same thing. Just Google them. And then you have that power of attorney that kind of controls all that stuff in your worst case scenario. So that trust owns everything else. So that trust owns that holding company. So the holding company is that essentially that first entity that exists underneath that will. And then all your different entities, they're all owned by that holding company. And that doesn't mean that it's 100% owned. Sometimes there's partial. So if you invest in a business, you have two other partners, you're a 33% owner in it, that 33% owned by the holding company. So Jake Claver doesn't own this. Jake Claver holding company, whatever you want to call it. Like we use essentially that family office. We have Wolf Holding Corp, and so that's our holding company, and then it owns all the different entities. I was talking about this yesterday with somebody. We're currently an owner of or a partner in 16 different businesses currently. So all 16 of those. I don't own any of those. So like, come at me. You ain't going to get much if you want to sue me. I don't know much. But the holding company owns all of that. So all these different entities exist in there, and they have different uses. So if you are an influencer, you need to have an entity that is owned by the holding company that does specifically that, right? You're in the entertainment business. You're an influencer, you're whatever, needs to be owned there, right? If you're a trader, you have an entity that's in the business of trading that exists right there. So you have this entity that's essentially your trading company, your self-directed IRAs, your solo 401k. That one's not the holding company, needs to be an entity, and then back down solo 401k, kind of paid on that one. Keep in mind that entity needs to be solo, right? Solo for a reason. Needs to just be that, like it's just you, maybe you and your spouse, if that works. But this is not an employee entity. This is just you to have the access to that solo 401k. Great way to defer some tax liability, to grow it. Self-directed IRA, there's some limitations there as well. That again, owned by an entity, not necessarily the holding company. So you've got two levels down. But whatever that is, you've got a business you're running over here, that LLC is over here. And so each one of these, and the reason we separate these is each one of these is going to have a different tax rate. So you've got a business that you're operating. Let's say it's some kind of retail store, right? So you've got sales and use tax, you've got sales tax, you've got all these other taxes that go into that. Let's say that's an LLC, so it's not a C corp. So that's going to be passed through income. You're going to be at the active rate. That's going to be your highest rate because it passes through to you individually. So you're at 10 to 37% for 2022. So potentially your highest tax rate, but that one also is you've got a lot of write-offs and other things that are going on in there. So you've got maybe you're a consultant, right? And so you have some consulting income, you're going out straight services business. This is a great one to have a solo 401k in because that's generally just you. Right. Usually don't have employees in that, or if you do, they're like contracts, they're not actually employees. So that consulting company, you have specific income that comes into that. And if you're controlling a lot of the entities that you're consulting, great way to kind of set your income up the way you want it. But that one maybe has your solo 401k. That one comes out. You've got that entity that's specifically for your trading. If you're into crypto, you're into NFTs. Maybe you're into metaverse. Yeah, stocks, bond, whatever, right? So that's your trading entity. That's the business of trading that allows you to write off a lot of things that would normally be passive. Now they've become active because you're in the business of it. Much better tax consequences, benefits, everything else. But it's the business of doing that. And then maybe you have some passive things that occur. Maybe you own some real estate that's creating passive gains, passive losses, if you need the passive losses, right? So if you have some real estate and you've got it in that's going to be passive. That tax rate is significantly less because we're talking about passive. So that's going to max out at your 20%. It's going to be your 0 to your 20%. But maybe that's where that exists, right? And then if you need those passive losses, you can always create cost segregation, right? Cost for segregation studies pay for themselves. Shameless plug, I own a cost segregation company. So if you need one done, holler at me. I got you. Cost segs are great because, not everything is depreciated on a straight line. Not everything is depreciated together. It's very rare that you buy a building and it doesn't have multiple levels of depreciation. And with a cost seg, you get all of that data, so you can make good decisions on how you're going to do it. So you can create
pull a lot of that. You can pull a lot of that depreciation sooner into the future than having to drag it out over a longer period of time, right? So instead of 7 years, it might be 3 to 5 to 7 to 10 years on some of those items. HVAC, flooring, walls, windows, all the different pieces of the real estate will depreciate at different rates, and so you can kind of write each one of those things off at a faster pace against you.
Exactly. It's the this is a very common story, so if your listeners have heard this story, just fast forward 30 seconds. But there's the paying for the roof twice, right? So if you depreciate something on a straight line, just the building, on that 20-year, that roof goes bad, and 3 years something happens, you got to replace that roof. You just lost 17 years of depreciation on that, right? And now you've bought the new one, it's increased your cost, and now you've incurred the full cost of replacing it, but your write-off, you just lost 17 years of that write-off, right? With a cost seg, even after the fact, like, so if it's happened within the last year or two to you, 100% do a cost seg, because you can back that up, and now you can take that bonus depreciation essentially. But instead of paying for it twice, you're only paying for it once, because with a cost seg, you're going to be able to depreciate that a lot faster. And then when you do, it's its own piece. So you fast forward that, and now instead of paying for it, you get the full write-off. So the cash does come out, but you get the full benefit of the full write-off. Not only the existing roof that should have already been depreciated, but now you get it on the new roof as well. So, common example of how cost segs work, but definitely a smart thing to do, and that's owned within the entity. So again, super fast forward version, trust, with a will, pour in will, got your power of attorney, holding company, all your different LLCs that kind of fall underneath it. And even these LLCs can own other LLCs. So if you have a series, that's a really easy one. Especially if you're in real estate, you don't have a series LLC, you're doing it wrong, start over, get one. That series can just, work its way down. And you have full control over that. So you can set your kids up for generational wealth. You can do a third generation trust. You set it up the way that you want to, so that you're taking care of, your family, your family's family, your grandkids, all the way down the line. I think it's very important that we leave legacies when we leave this world. And that is the easiest and best way to leave a legacy, is to set all of your future generations up for success. That to me is the best legacy I can ever leave.
Yeah, I love it, man. I think that's going to be just about the time that we have for this one. That's our 30 minutes. So we'll continue this conversation on the next one, as we segue our way through the world of digital assets and Web3. Thank you guys for joining us again, and we'll see y'all on the next one.
Thanks, Jake.